Welcome to Unit 19, the Union Budget. The Union Budget is the single most important financial document of the Government of India. It is presented every year in Parliament by the Finance Minister, now on the 1st of February, so that its provisions can be implemented right from the start of the financial year on April 1st. Since 2017, even the rail budget, which used to be separate, has been merged into the Union Budget, making it a comprehensive statement of the nation's finances. Let's break it down into two major parts, receipts and expenditure. Receipts are the money that flows into the government. These are divided into revenue receipts and capital receipts. Revenue receipts include tax revenues such as corporation tax, income tax, customs duties, excise duties, and GST. They also include non-tax revenues like interest payments received, dividends from public sector enterprises, and external grants. Capital receipts, on the other hand, are of two types: non-debt receipts such as recoveries of loans and disinvestment proceeds, and debt receipts like borrowings from the market, small savings, provident funds, and external debt. When we add revenue receipts, capital receipts, and any drawdown of cash balances, we arrive at the total receipts of the government. Now let's move to expenditure, the money the government spends. Expenditure is classified into non-plan expenditure and plan expenditure. Non-plan expenditure covers items like interest payments, defense, subsidies on food, fertilizer and petroleum, pensions, police, grants to states, and social services such as education and health. It also includes capital outlays like defense equipment and loans to states or public enterprises. Plan expenditure, on the other hand, is developmental in nature. It includes both revenue and capital spending on central plans and assistance to state plans. Together, these form the total expenditure of the government. But the real story of the budget lies in the deficit concepts. Revenue deficit occurs when revenue expenditure exceeds revenue receipts. Effective revenue deficit refines this by subtracting grants used for creating capital assets. Fiscal deficit is the most watched number. It shows the gap between total expenditure and total receipts, excluding borrowings. In simple terms, it tells us how much the government needs to borrow to meet its expenses. Primary deficit is fiscal deficit minus interest payments, showing the borrowing requirement without the burden of past debt. These deficit figures are crucial because they reflect the health of the economy, the sustainability of government finances, and the burden on future generations. To sum up, the Union Budget is not just an accounting exercise. It is a roadmap for the country's growth, welfare, and fiscal discipline. It tells us how resources are mobilized, how they are spent, and how deficits are managed. For students of banking and finance, understanding the Union Budget is essential, because it connects directly to monetary policy, credit availability, and the overall financial system.
Question number 1. The Union Budget is presented in Parliament by Option A, Prime Minister. Option B, Finance Minister. Option C, President. Option D, RBI Governor. Answer B, Finance Minister. Question number 2. Since 2017, the Union Budget is presented on Option A, the 31st of March. Option B, the 1st of February. Option C, the 15th of August. Option D, last working day of February. Answer B, 1 February. Question number 3. The railway budget was merged with the Union Budget in Option A, 2015, Option B, 2016, Option C, 2017, Option D, 2018. Answer C, 2017. Question number 4. Revenue receipts consist of Option A, tax revenue jor non-tax revenue. Option B, borrowings jor disinvestment. Option C, recoveries of loans jor external debt. Option D, market borrowings only. Answer A, tax revenue jor non-tax revenue. Question number 5. Which of the following is not a tax revenue? Option A, income tax. Option B, GST. Option C, customs duties. Option D, dividends from RBI. Answer D, dividends from RBI. Question number 6. Capital receipts include Option A, recoveries of loans, disinvestment, borrowings. Option B, income tax, GST, customs. Option C, interest receipts, dividends. Option D, subsidies. Answer A, recoveries of loans, disinvestment, borrowings. Question number 7. Net tax revenue equals gross tax revenue states as share. Option A, fiscal deficit. Option B, NCCD, National Calamity Contingency Duty. Option C, subsidies. Option D, external debt. Answer B, NCCD. Question number 8. Disinvestment proceeds are classified as Option A, revenue receipts. Option B, capital receipts, non-debt. Option C, capital receipts, debt. Option D, grants. Answer B, capital receipts, non-debt. Question number 9. Revenue expenditure includes Option A, defense salaries, subsidies, pensions. Option B, infrastructure projects. Option C, loans to states. Option D, disinvestment. Answer A, defense salaries, subsidies, pensions. Question number 10. Capital expenditure includes Option A, interest payments. Option B, subsidies. Option C, loans to states or UTS, defense capital outlay. Option D, pensions. Answer C, loans to states or UTS, defense capital outlay. Question number 11. Non-plan expenditure includes Option A, interest payments, defense, subsidies. Option B, central plan schemes. Option C, state plan assistance. Option D, railways projects. Answer A, interest payments, defense, subsidies. Question number 12. Plan expenditure includes Option A, central plan JOR assistance to states, UTS. Option B, defense salaries. Option C, pensions. Option D, police. Answer A, central plan JOR assistance to states, UTS. Question number 13. Revenue deficit. Option A, revenue receipts, revenue expenditure. Option B, revenue expenditure, revenue receipts. Option C, capital expenditure, capital receipts. Option D, fiscal deficit, interest payments. Answer B, revenue expenditure, revenue receipts. Question number 14. Effective revenue deficit equals revenue deficit. Option A, subsidies. Option B, grants for capital assets. Option C, borrowings. Option D, interest payments. Answer B, grants for capital assets. Question number 15. Fiscal deficit equals total expenditure, revenue receipts. Option A, borrowings. Option B, non-debt capital receipts. Option C, interest payments. Option D, subsidies. Answer B, non-debt capital receipts. Question number 16. Primary deficit equals fiscal deficit. Option A, subsidies. Option B, interest payments. Option C, revenue deficit. Option D, grants. Answer B, interest payments. Question number 17. A high fiscal deficit indicates Option A, strong revenue collection. Option B, high borrowing needs of government. Option C, surplus budget. Option D, low expenditure. Answer B, high borrowing needs of government. Question number 18. Which of the following is a non-tax revenue? Option A, customs duties. Option B, GST. Option C, interest receipts. Option D, excise duties. Answer C, interest receipts. Question number 19. Subsidies, food, fertilizer, petroleum, are part of Option A, revenue expenditure. Option B, capital expenditure. Option C, non-debt receipts. Option D, fiscal deficit. Answer A, revenue expenditure. Question number 20. Primary purpose of union budget is to Option A, measure GDP growth. Option B, present government's receipts and expenditure plan for the year. Option C, calculate HDI. Option D, assess green GDP. Answer B, present government's receipts and expenditure plan for the year.